The warning signs did not begin with a market crash or a sudden policy shift. They emerged quietly, embedded in invoices, contract revisions, and whispered concerns across construction sites. Across the United States, the cost of a fundamental building material, lumber, began climbing with unsettling speed. For homebuyers already navigating elevated mortgage rates and affordability pressures, the surge delivered another blow. For builders, it triggered a chain reaction of recalculations, delays, and uneasy forecasts. What initially appeared to be a cyclical fluctuation soon evolved into something more destabilizing, raising questions about supply chains, trade tensions, and the resilience of the housing sector itself. Behind the numbers lies a deeper anxiety reverberating through financial markets and households alike. Housing is not merely an economic indicator, it is intertwined with social stability, consumer confidence, and long-term wealth. When lumber prices smash records, the consequences ripple far beyond sawmills and timber exporters. They reach first-time buyers confronting shrinking budgets, renters watching dreams of ownership drift further away, and policymakers grappling with inflationary pressures. The tension is not abstract. It is visible in stalled projects, rising contract costs, and a growing unease that one of the economy's most sensitive pillars may be entering another period of strain. Lumber has long been a barometer of broader economic cycles. Its demand often accelerates ahead of housing booms and contracts sharply during downturns. The material's price movements reflect not only construction activity, but also global trade dynamics, transportation bottlenecks, and speculative trading. Historically, volatility in lumber markets has accompanied moments of structural stress, including financial crises and pandemic disruptions. Yet the latest surge has been marked by a unique combination of forces, blending persistent supply constraints with renewed demand pressures. Analysts note that the scale and persistence of recent price increases have unsettled assumptions about how quickly markets self-correct. The roots of lumber market instability stretch back years. Trade disputes between the United States and Canada, one of America's largest lumber suppliers, have periodically reshaped tariffs and import flows. Environmental regulations, wildfires, and pest infestations have further constrained North American timber production. Meanwhile, consolidation within the forestry industry has altered pricing power and capacity decisions. Each factor alone might have been manageable. Together, they created a fragile equilibrium, vulnerable to shocks. When pandemic-era disruptions collided with surging housing demand, that equilibrium fractured, exposing structural weaknesses across procurement and distribution networks. During the early stages of the COVID-19 pandemic, sawmills reduced output amid uncertainty and safety concerns. Demand, however, rebounded faster than expected as low interest rates and shifting living preferences fueled home purchases and renovations. The mismatch triggered an extraordinary spike in lumber prices, briefly pushing costs to unprecedented levels. Although prices later retreated, the episode left lasting scars. Builders absorbed heavy losses, suppliers tightened risk management strategies, and buyers became wary of unpredictable material expenses. Industry leaders warned that the volatility was not an anomaly, but a preview of deeper vulnerabilities within global supply chains. Climate-related disruptions added another layer of complexity. Severe wildfires across Canada and the western United States damaged vast forest areas, curtailing harvest volumes and temporarily shutting mills. Extreme weather events complicated transportation routes, delaying shipments and increasing logistical costs. Forestry experts cautioned that such disruptions were likely to intensify, driven by rising temperatures and shifting ecosystems. The intersection of environmental risk and industrial capacity began to redefine the economics of timber production. What had once been viewed primarily as a commodity issue increasingly became a climate resilience challenge with macroeconomic implications. Trade policy continued to play a defining role. U.S. tariffs on Canadian softwood lumber, periodically revised through lengthy negotiations, introduced uncertainty into pricing and sourcing strategies. Canadian producers argued that duties distorted markets, while U.S. officials maintained they were necessary to counter unfair subsidies. The dispute underscored the interconnectedness of North American housing and forestry sectors. Even modest tariff adjustments could influence billions of dollars in cross-border trade. Builders, often operating on thin margins, watched closely as diplomatic decisions translated into material cost fluctuations that could determine the viability of entire developments. Beyond North America, global demand patterns shifted. Rapid urbanization in Asia, Infrastructure investments and post-pandemic stimulus programs increased competition for timber products. Shipping constraints and container shortages elevated freight costs, amplifying price pressures. Financial investors responding to inflation concerns and commodity cycles intensified speculative activity in futures markets. Economists observed that lumber prices were increasingly sensitive not only to physical supply and demand, but also to financial sentiment. The convergence of geopolitical, environmental, and financial drivers produced a volatility environment few industry participants considered stable. Against this backdrop, the U.S. housing market entered a delicate phase. Mortgage rates climbed sharply following aggressive monetary tightening aimed at curbing inflation. Affordability deteriorated, with monthly payments rising even as home prices remained elevated. Builders confronted slowing demand and tightening credit conditions. Yet the renewed surge in lumber costs complicated the narrative. Higher material expenses threatened to push new home prices upward precisely when buyers were most price-sensitive. Industry associations warned that cost pressures risked exacerbating an already constrained supply of affordable housing, deepening structural imbalances. By the time lumber prices began smashing records again, builders had little cushion. Many firms had only recently stabilized balance sheets after earlier volatility. Contracts negotiated months earlier suddenly appeared mispriced. Developers reported escalating bids from subcontractors factoring in uncertain material costs. Delays multiplied as projects were reassessed or paused. For large national builders, the shock could be partially absorbed through scale and hedging strategies. Smaller regional operators, however, faced acute stress, with some warning that sustained price surges could render projects financially untenable. Homebuyers felt the effects almost immediately. Prospective buyers encountered rising quotes for new builds and renovation projects. Adjustable rate borrowers weighed additional uncertainty as inflationary pressures intersected with financing costs. Housing economists noted that even incremental increases in construction expenses could translate into thousands of dollars added to purchase prices. For households already stretched by higher interest rates, the impact was significant. Surveys indicated growing hesitation among buyers, reflecting concerns not only about affordability, but also about market stability and the risk of entering transactions amid unpredictable cost dynamics. Financial markets reacted with caution. Shares of major home builders exhibited heightened volatility as analysts revised earnings forecasts. Some investors anticipated margin compression, while others pointed to potential pricing power in constrained housing markets. Commodity traders debated whether the surge represented a temporary supply shock or a more durable shift. Central bank officials monitored developments closely, wary of renewed inflationary pressures emanating from construction and housing costs. The interplay between commodity prices and monetary policy once again entered the spotlight, highlighting the delicate balancing act facing economic authorities. Within Washington, policymakers faced competing pressures. On one hand, stabilizing housing affordability remained a political priority. On the other, addressing inflation required maintaining restrictive monetary conditions. Officials acknowledged that lumber price volatility complicated both objectives. Discussions emerged around potential adjustments to trade policies, strategic reserves, and support for domestic timber production. Yet such measures carried risks, including unintended market distortions and diplomatic repercussions. The policy debate underscored a broader challenge: how to manage sector-specific shocks without undermining long-term economic stability. Industry executives described a climate of uncertainty rather than panic. Many had developed contingency strategies after earlier price spikes, including diversified sourcing and contractual safeguards. Nevertheless, the renewed surge tested those defenses. Suppliers reported strained inventories and extended lead times. Contractors renegotiated terms to account for fluctuating costs. The sense of déjà vu was palpable, yet the economic environment differed markedly. Higher interest rates and slower housing demand limited the sector's capacity to absorb additional shocks. The convergence of cost pressures and financial tightening heightened concerns about potential knock-on effects. Analysts offered varied interpretations. Some attributed the surge primarily to temporary supply disruptions, including wildfire-related mill closures and transportation constraints. Others pointed to structural factors such as chronic underinvestment in sawmill capacity and persistent trade frictions. A growing number emphasized the role of financial speculation, arguing that futures market dynamics amplified price swings beyond fundamentals. Regardless of the precise drivers, there was broad agreement on one point. Volatility itself had become a defining feature, complicating planning and investment decisions across the housing ecosystem. Economists highlighted the broader macroeconomic implications. Housing activity influences employment, consumer spending, and credit markets. Sustained disruptions can reverberate through related industries, from appliances to financial services. Rising construction costs risked feeding into inflation metrics, potentially affecting monetary policy trajectories. At the same time, slower housing activity could dampen growth. The dual risks, inflationary pressure and growth deceleration, illustrated the complexity confronting policymakers. Lumber prices, once a niche commodity story, had re-emerged as a symbol of interconnected vulnerabilities within the modern economy. Environmental experts warned that climate-related supply disruptions were unlikely to abate. Increasing wildfire frequency, pest outbreaks, and shifting forest ecosystems threatened timber yields and operational stability. Adapting would require long-term investments in forest management, infrastructure resilience, and diversified materials. Builders began exploring alternatives, including engineered wood products and non-wood construction methods. Yet such transitions carried costs and regulatory hurdles. The intersection of climate risk and construction economics suggested that volatility might persist, demanding structural adjustments rather than short-term fixes. Trade specialists emphasized geopolitical dimensions. Lumber flows reflect not only market forces but also diplomatic relationships and regulatory frameworks. Tariff adjustments, subsidy disputes, and sustainability standards influence competitive dynamics. In a period of heightened global trade tensions, commodity markets often serve as arenas for broader strategic competition. Observers noted that lumber disputes could intersect with climate policy, industrial strategy, and regional economic interests. The housing sector, reliant on stable material supplies, remained particularly sensitive to such cross-currents. Insiders within the construction industry described operational consequences extending beyond pricing. Project scheduling became more complex as procurement timelines lengthened. Financing arrangements required greater flexibility to accommodate cost variability. Insurance considerations evolved to reflect heightened environmental risks. Contractors faced workforce challenges as delays disrupted employment continuity. The cumulative effect was a climate of caution. While few predicted an immediate collapse, many acknowledged that sustained instability could erode confidence, potentially discouraging investment in new housing developments. Housing advocates voiced concerns about affordability and inequality. Rising construction costs disproportionately affect entry-level housing segments, where margins are thinner and buyers more price-sensitive. Delays and cancellations reduce supply, intensifying competition in rental markets. Economists warned that prolonged cost pressures could exacerbate existing disparities, widening gaps between homeowners and renters. Policymakers face difficult choices: intervene to stabilize markets or allow price signals to drive adjustments. The social implications of housing volatility underscored its significance beyond purely economic metrics. Financial risk analysts assess potential spillovers. Elevated costs and delays increased default risks for leveraged developers. Banks and lenders reviewed exposure to construction loans and builder credit lines. Although capital buffers were stronger than during previous crises, vigilance remained high. Memories of past housing downturns informed risk management strategies. Regulators emphasized the importance of monitoring sector-specific stress indicators. Lumber prices alone would not trigger systemic instability, analysts argued, but in combination with broader financial pressures, they could contribute to localized strains. Looking ahead, scenarios varied widely. Some experts anticipated a correction as supply disruptions eased and demand moderated. Others warned that structural constraints, including environmental and capacity challenges, might sustain higher price levels. Builders weighed decisions about scaling back projects or passing costs on to buyers. Home buyers evaluated timing amid uncertainty. Policymakers considered targeted interventions. The central question remained unresolved: whether the surge represented a temporary disturbance or a signal of a more volatile era for construction inputs and housing economics. In the short term, market participants focused on indicators of stabilization. Mill reopening schedules, freight rates, and inventory levels became closely watched metrics. Futures markets reflected cautious optimism tempered by persistent uncertainty. Builders accelerated efforts to lock in prices through contracts and hedging instruments, yet risk premiums remained elevated. The experience of repeated volatility had reshaped expectations, encouraging more conservative planning assumptions. Industry leaders acknowledged that flexibility and resilience, rather than precise forecasting, had become essential strategic priorities. Longer-term adjustments appeared inevitable. Diversification of materials, investment in domestic production capacity, and enhanced supply chain transparency featured prominently in industry discussions. Governments explored policies supporting sustainable forestry and infrastructure resilience. Technological innovations in construction methods offered potential efficiencies. Nevertheless, transitions require time and capital. The challenge lay in navigating immediate pressures while laying foundations for greater stability. Economists cautioned that without structural reforms, cycles of volatility could recur, undermining housing affordability and investment confidence. The housing sector's trajectory would also depend on broader economic conditions. Interest rate paths, labor market trends, and consumer confidence influence demand dynamics. A slowdown could temper price pressures, but risk weakening builder finances. A rebound might restore momentum, yet intensify competition for materials. Policymakers face delicate trade-offs, balancing inflation control with growth support. Lumber prices, though a single variable, intersected with each dimension. The episode underscored the intricate feedback loops linking commodity markets, monetary policy, and housing activity. For homebuyers, uncertainty remained a defining feature. Some postponed purchases, anticipating potential price corrections. Others accelerated decisions, fearing further cost increases. Mortgage lenders adapted offerings to reflect shifting risk assessments. Housing counselors reported heightened anxiety among first-time buyers. The psychological dimension, expectations of stability or instability, influenced market behavior as much as numerical indicators. Economists observed that confidence, once shaken, can take considerable time to rebuild, shaping demand patterns long after prices stabilize. Builders adopted varied strategies. Larger firms leveraged scale to negotiate supply contracts and absorb temporary margin pressures. Smaller operators pursued niche markets or delayed expansions. Collaboration between industry stakeholders intensified, aimed at improving forecasting and risk management. Trade associations advocated policy clarity and infrastructure investment. The shared objective was not merely navigating a single surge, but enhancing resilience against recurring shocks. The lessons of recent volatility informed decisions about capital allocation, procurement practices, and operational flexibility. Environmental sustainability entered the conversation with renewed urgency. Sustainable forestry practices, reforestation initiatives, and alternative materials gained prominence. Policymakers linked climate resilience to economic stability, emphasizing the need for integrated strategies. Industry leaders highlighted opportunities for innovation, from engineered wood products to circular construction models. Yet tensions persisted between short-term cost pressures and long-term environmental goals. Balancing affordability, sustainability, and stability emerged as a central challenge for stakeholders across the housing and forestry sectors. Global observers monitored developments closely. Commodity price volatility, housing affordability challenges, and climate disruptions are not uniquely American phenomena. Similar dynamics have surfaced in Europe, Asia, and emerging markets. The interconnected nature of supply chains means shocks can transmit rapidly across borders. Analysts noted that lumber price surges could influence global inflation metrics, investment flows, and policy debates. The episode illustrated how sector-specific disruptions can acquire international significance, reshaping narratives about economic resilience in an era of compounding uncertainties. Ultimately, the story of lumber prices and housing jitters is not defined solely by market charts. It reflects deeper structural questions about supply chain resilience, environmental risk, and policy coordination. Repeated volatility challenges traditional assumptions about predictability and adjustment. Stakeholders across industries confront a reality in which shocks may be more frequent and interconnected. The implications extend beyond construction budgets to social stability and economic confidence. As one analyst observed, the question is no longer whether volatility will occur, but how systems adapt to endure it. In the closing analysis, there is neither inevitability nor immediate catastrophe. Markets can stabilize, policies can adjust, and industries can innovate. Yet the warning embedded in record-breaking lumber costs is unmistakable. Housing, a cornerstone of economic and social life, remains vulnerable to forces far beyond individual transactions. The episode serves as a reminder that resilience requires foresight, coordination, and sustained investment. Whether the sector emerges stronger or more fragile will depend on choices made across boardrooms and government offices in the months ahead. What remains is a landscape marked by caution, adaptation, and unresolved tension. Homebuyers weigh decisions amid shifting prices and financing conditions. Builders navigate cost uncertainties and evolving demand. Policymakers balance inflation control with growth and affordability objectives. Lumber prices may eventually retreat, but the memory of volatility endures. In that memory lies a broader lesson about the fragility and interdependence of modern economies. The anxiety coursing through housing markets is not merely about timber costs, but about confidence and stability itself.